Welcome back to the channel. My name is Brad, and today we're going to take a look at where these covered calls are at, compare them to others, and see which ones are recovering the fastest. If this is what you're looking for, stay tuned. So the first one we're going to look at today is GIAX. I'm a fan of GIAX. Don't know why, I just am. I like the diversity. But look at the diversity of their calls. They wrote them on two separate indexes in a very different staggered way. They wrote one on RUTW. It's currently over 5% out of the money. So there is lots of room for that to grow. The smallest one that they wrote was on SPXW, and right now it is sitting right in the middle, in between the spread. So once it gets above that 59.50 strike, it will start gaining again. And the last one that they wrote was on SPXW, and this was a larger percent of the total call writing for the week, and it is still 2.6% out of the money. So knowing this, any growth that we see in this fund for the next almost week and a half, I mean, today's the 21st, and it's going to go to December 30th. So if there's 2.6 gain, we're going to probably see most of it, if not all of it. So I'd like that. Good job, GIAX. That's where they're at. You can see where it's going. If I look at SPYI, they're at 3.6% out of the money. Their calls are staggered. They usually roll them first of the month. So we still have another couple weeks. And they're going to grow another 3.61 if the market goes up. If the market goes down, we'll see the losses. If the market goes up, we'll see the gains. So they're a little bit out of the money, and I like that. QQQI, another NEOS fund. Because you know I have NEOS. They can go up another 0.5% before they even touch their first strike. Keep in mind that NEOS writes staggered calls on about 75% of the portfolio. So even if they get up to the top strike, it doesn't really matter because 25% of the portfolio is still not written on. So we'll still see some gains. I hope it gets up to that 1.81. And these strikes are about 50% each. So you can start doing the math. It's right around that 35 to 37% for each one of those strikes. IWMI. Oh, we don't have to worry about them touching the strikes anytime soon. So congratulations, you're going to get your 14% and you're going to get on down the road. Now, the Russell has taken a beating recently. And that's because the Fed and everybody else is boo-hooing on lowering rates, and everybody was betting on the Russell 2000 going up because of the lower rates. But we will see how this works out, how it doesn't work out. I still hold my IWMI. I have all three indexes. I have the SPY, I got the Qs, I got the Russell. I do the GIAX because it actually holds all three indexes. It holds mid caps and it holds some international. So that is my diversification play across the portfolio of these funds. Now, I will tell you, in retirement, it is not only total returns, it is also percentage. So these funds pay me about 12% compared to other funds that may pay 8 or 9%. I want that extra 1 or 2% and something that goes up and to the right over time, because I'm living on these distributions. Not a game, not trying to grow my wealth, but living on these funds. Unlike other people going out and telling you that total returns is all that matters or total returns doesn't matter. All I'm saying is total returns matters, so does your NAV, so does the percentage. And it's all up to you to make the decision on what you want to do. Now, let's take a quick look at these different funds over time on Friday, because Friday was a recovery day. GIAX was up 95%. QQQT, which sells daily call spreads, was up 0.73. And SPYI was up over 1%. I look at this and say, very good. Keep in mind, GIAX is more diversified, holds the Qs, holds the SPY, and holds the Russell. So you gotta sit back and say, sometimes it is the underlying that holds it back compared to others. Now we're gonna go and talk more about the Qs. I hold QQQI. It recovered 0.68. JEBQ recovered 0.7. JPIQ recovered 0.77. The difference is I'm going for a larger percentage because I'm in retirement. And I will take that little bit of hit, just that little bit of hit. Now keep in mind also that NEOS actually holds all the underlying. They hold every single one of them. So there might be a tracking issue also. It's not like they hold the Qs and then sell those spreads. They hold every one, so there might be a little tracking. They could also be doing some harvesting for your taxes. So keep that in mind, that not all the time does it have to track exactly perfect, because they could be harvesting some losses for your taxes. They are definitely more tax efficient. So XDTE is up 0.25%. T-SPY is up almost 1%, and I-SPY is almost up 1.3%. I look at this going, these are interesting numbers. You can see how this plays out. You can see the highest payer is not making as much in recovery as the median payer. You can see that the median payer didn't recover as much as the lowest payer, but it all comes down to where they write their strikes and what their goals are. I look at IQQQ and I look at QDTE. Well, again, lower payer against a higher payer. And you sit there and go, one recovers 0.79, one recovers 0.19. All of this really doesn't matter until you start looking at the charts, comparing them side by side. QDTE is up, total returns, 11.04. QQA is up 7.87. IQQQ is at 6.55. QQQI is up 8.42. JEBQ is up 9.05. And the Qs are sitting at 7.38. So all reality except IQQQ, they're all beating the index. All of them. The question is do you want that high payer with those high total returns with maybe some other issues behind it? If I look at QDTE and their actual percentage to their NAV that everybody seems to want to talk about, they're down 6.81. QQA is up 4.16. IQQ is up 1.7. QQQI is up 2.1. JEBQ is up 4.1. And of course the Qs are up in the 7s. So do you want total returns, no NAV erosion, or do you want, I don't know what you guys want. You take the pick. I'm not going to tell you which one to pick and which one not to pick. But if you're picking QTTE because of total returns, expect NAV erosion. I think the charts are definitely clear telling you you should expect it. Now let's look at some of the other funds. We're going to look at price return and we're going to look at T-SPY. They're up 3.4. S&P 500 is 5.8. XDTE minus 1.9. SPYI 1.7. JEPI 0.14. And JPIX 3.36. I look at this chart, cross around, going, do you want something that is below and has NAV erosion, even though I've seen videos that they say NAV erosion doesn't exist? Well, I guess I don't know what they're thinking. And it all, again, comes down to strike price and how aggressive one is compared to the other. Do you take the highest payer? Do you take the medium payer? Which one do you pick? And this is all a personal preference, because at the end of the day, you're talking very small percentages in between them. If I look at total returns, T-SPY 6.99, XDTE 7.24, SPYI at 5.41, JEPI at 2.83, and GIAX at 6.35. You can see how these all played out. You can see which ones are winners. You can see which ones are losers. I pick ones that have a higher percentage because I live on higher percentages. There's also a thing about higher percentages can take a bigger dip and still get me my 8%. That is just how mathematically it functions. You can take 1 minus the percentage that you want to withdraw divided by the percentage that it's paying, and you can find out how much of a drawdown that fund can handle and still get you the percentage that you want. Hopefully you understand that math, but I'm going to guess by many comments that you probably don't. But feel free to email me and I will send you the graph and I will send you the equation, because I really don't care if you have it or not, because you should have it and you should be doing your own research. Hopefully this gives you a little bit of idea of what these things are doing and how they're doing, and which ones recovered, which ones didn't recover, which ones you may or may not want to get into. They're all good funds, just that you have to understand what you're getting into and which one might recover, which one might not recover, and which one will pay higher yields, and which ones do you want to live off of, and which ones. There's a lot of which. Take your pick. Don't always pick what I pick, because I might be picking the wrong ones. But I got a feeling that I'm picking the ones that have good, high yields, maintain a good upward slope to the right, so I can take my 8% and live happily ever after. Until next time, God bless.